Afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. I want to say good morning to those of you who are joining us on the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones as well. Of course, we want to say good evening if any of you are joining us from across the pond in parts of UK or parts of Europe, and good early morning for any of you who are joining us from parts of Asia or Australia. Welcome to today's presentation. Today we're going to talk a little bit about managing your broken stock, maybe managing some of your bullish options positions as well. We want to talk about some of the ideas you might not be familiar with on getting back to break even using different option strategies on your long stock or covered call positions. Maybe you've been put stock as part of a naked put, this recent downtrend that we've seen in the market in the past 3 weeks or so. We're also going to talk about management techniques for repairing other bullish option strategies, taking a look at maybe bull put credit spreads, bull call debit spreads, and perhaps calendar spreads as well. Now, for those of you who don't know me, my name is Mike Chupka. I am the Director of Education here at Power Options. Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We support search, analysis, and tracking tools for over 23 of the most commonly used option strategies. In addition to the search and the management capabilities of our tools, we also offer various help videos, tutorials, and archived webinars to help you get more familiar with the tools on the site and the various option strategies as well. Now, today's presentation, of course, regardless of our preferred strategy, whether you're using just long options, whether you're using long stock positions and you're just getting into options, whether you're doing covered calls or naked puts, as we mentioned, or maybe some of the vertical spreads, we're going to have times like this where the market just seems to not want to know what it wants to do, but it's going against maybe every thought that we have, and even we might have had thoughts that when we saw the downturn begin, okay, it's going to settle down and maybe it's going to pull back, so I'll wait to manage, and then we see another 3 or 4 days of the market moving down and figure, okay, maybe this is the bottom. We'll wait a little bit and look to adjust our positions after it comes back, and then it continues down a little bit more as we've seen today. Now, we all know maybe the common ways of adjusting some of these positions. We hopefully are going to introduce you to some new ones today that you might not have considered and help you get back to break even faster. Now, before we talk about some of those techniques, if we're in a long stock or maybe even part of a covered call or even a naked put position, some of the common preemptive management that we would use in our account, and we hopefully are using our account, is mental stops. We read a lot of things there in IBD, and William O'Neill talks about closing a position if you see a 7 or 8% decrease in the underlying security. But this is easy to talk ourselves out of. When we get into a stock, maybe we just purchased the stock at the end of December, looking for new runs, or maybe even early on in January. And then the first couple days we see the stock drop down maybe 5 or 6%. Maybe we hit that mental stop, but we figure, okay, it's just bad luck. Okay, it's just bad timing. It's going to come back up a little bit. We'll be able to adjust it at that time. But then it keeps going down. And now we're in this thought where we don't want to admit to ourselves that we were wrong. The psychology of trading. We also don't want to get out at maybe a 10% or 12% loss. We've got to manage the position. Instead of using a mental stop, you might have used a hard stop order to prevent loss. This might have worked in the last 3 weeks where you got closed out of a position maybe at a 7 or 8% loss, but then you saw another 4 or 5 or 6% decrease in your underlying security. Maybe you're looking to get back in. But the other thing to remember, of course, is we are entering into earnings season, and having a hard stop on your position, assuming that's going to help you in the case of a pre or aftermarket gap down in the underlying security, whether you're in a spread position or a covered call or a naked put. If the stock drops 25 or 30% for a poor earnings announcement, that 7 or 8% stop order will not help you. It will get violated, and you, of course, will get closed at the worst possible price. And this is usually where we tend to realize the largest loss is because of a stop order. And of course, the trailing stop order can work in common market conditions, but at the same time, if there's a large decline in the price, we can end up getting violated. All right, so let's talk about why we're here. The market has been tumultuous. It's been unexpected, maybe. It's been where we've seen it falling down, and okay, we can stomach a little bit of loss, but it's got to recover eventually. We just haven't seen that recovery in the past 2 weeks. Every day I think of adjusting one of my positions to look for the bullish side now that we've seen this decline. I hesitate a little bit and it just keeps dropping down in price. Could have made a lot of money, and I hope a lot of you did, playing some of the downside when we first started seeing this at the beginning of January. However, at any given time, we're going to have stock. We're going to have stock in our portfolio, even if we're trading options, maybe stock that we inherited, and we're going to see stock that's down in price. All right, so what are the common management techniques for just a long stock position? And this can count for a covered call position as well, or if you were put stock early because of a decline. Well, the first one's obvious. We average down. We have some money invested in a position, the stock drops, we can add more money into the position, but had we done this a week ago or 2 weeks ago when the market started to pull back, we run the risk of putting good money into a bad position, realizing larger monetary losses. Those of you doing covered calls, or maybe you're just in the stock and you're interested in options, your stock has fallen, and you figure, okay, let's just sell a call against our stock. Let's enter a covered call position. And what this will allow us to do, of course, is take in income. We've entered a contract to deliver our shares of stock. But at the same time, if I bought a stock at 45, I watch it fall down to $41 per share, maybe I sell a 41 or 42 strike weekly call to generate some premium to help hedge some of the loss, but then the stock recovers and quickly moves back up to 43. I'm going to have to pay more now to buy back that call to stay in the position, or I could get assigned early and be locked into a loss. There's also a lot of elaborate repairs that are out there, and this works for even, or is discussed, I should say, for a long call position, where we could turn the position into a broken wing butterfly, or sort of an elaborate 3- or 4-legged ratio call spread to try to help us repair the position. That can be lucrative if and only if the stock goes back to your expectation. We're actually going to look at that, and that's going to be one of our focuses today. Now, we talked about covered calls as well. If you're already in a covered call, same situation, you've seen your stock fall maybe 12 or 15% since you entered the covered call position. Well, the call that you originally sold, you can buy it back and probably make 75, 80, 85% or higher of what you expected to make. All right, so you've got most of that in. You can roll the call down in price. Same scenario, we bought a stock at 42, maybe we sold the 42.50 call, but in the last 2 to 3 weeks, we've seen that stock drop down to 36. Okay, buy my 42.5 call back for maybe 10 cents and maybe sell a 37.50 call going out in time to maybe January or February. Okay, well, what happens now is if the stock does recover, if it gaps back up in price, we may lock in a loss. We may get assigned early on that situation. And of course, we also may get into a position where we don't get enough premium for the call that we'd want, and the potential return if assigned would be a negative value. We're going to take a look at one of those examples as well. A quick question, I'm sorry, came in from Jerry. Can I watch the recording as I have to leave soon? Yes, Jerry. I'm going to send everyone a chat link very quickly here. All right, I am recording today's presentation. We will post it later on this afternoon. At any time, whether you're a member of Power Options, trial member, or a subscriber, you can go to our webinars page. You don't need to be logged in. It is a public page. Chat window there in your GoToMeeting platform. I just sent you a link to powerop.com/webinars.asp. You will see this presentation listed in the Options Strategies category. It's going to replace the existing webinar, that we already have called Manage Your Broken Stock. All right. Now, those of you who may be selling cash-secured naked puts, similar risk-reward profile to a covered call position, but you probably already started 5, 10, 15% maybe out of the money to have a little cushion. Selling that out of the money put, of course, allows you to buy shares of stock at a lower price. But if the stock stays above it as you go to expiration, your put naturally would expire worthless. You'd keep the premium. But even with an 8 to 10% range out of the money, maybe we got that stock at when the stock, was trading at 42. Maybe we sold a 40 or even a 37.5 put, but now the stock's trading down in the $36 range or the $35 range. Okay, we might be forced to buy shares of stock. We may have been forced to buy shares of stock last week. Our loss isn't going to be that big, but again, how do we repair that position? Well, depending on the loss, the common repairs we talked about, now that we are in a long stock position, if we didn't adjust it beforehand, or again, you got assigned early, the common repairs would be similar to a covered call. Now that we own stock, we could sell a call at a lower strike. We can convert our new stock position into a covered call. Of course, we could also roll the put prior to being put the stock, but that gives us the similar problems with a covered call. So if we buy to close our put and maybe roll it down, the stock continues to fall, we still might get put the stock at a lower price, maybe compound those losses that we're taking. However, if the stock recovers and moves back up, the premium that we receive for selling that lower strike call might not have really helped us hedge the loss we took originally. Now, are there ways to get back to break even faster? One of the things that we like to use at Power Option is called the stock repair. It is a ratio call spread, which does have its pros and cons as well. But I wanted to show you today to make sure you're aware of the stock repair to see how it can help you get back to break even faster, plus combined with some of our other common ways that we may adjust our long stock position or a covered call that has fallen against us as well. Now, in a ratio call spread, what we're going to do is we're going to buy calls equal to the shares owned. So if I own 100 shares of stock, I'm going to look for a repair where I'm going to buy one call, and then I'm going to look to sell twice as many calls at a higher strike price. So with a repair, I might buy a call at, let's say, a $40 strike, and then sell two calls at the 42.5 strike. I want to try to generate a credit, meaning the premium we get for the calls that we sold are greater than the cost of the one call that we bought. Okay? All right, so that's what we're going to look at here with a quick tool. And of course, in most situations, it's going to work to be combined with other management techniques as well. So quickly, we're going to take a look now at some of those examples. We're going to take a look at Kroger. This is actually a position in my personal account that I'm into as a radioactive trade. I do have a put protecting it, but the stock has fallen. Back at the end of December, around 12/30/2015, we could have bought 100 shares of Kroger at around $42.31. Maybe if we did a covered call at that time, speculating that the stock would move up, we might have sold a 42.5 at the money call, generated maybe $1 worth of premium. And of course, if anyone has a stock right now, a long stock position or a covered call that's down in price, please feel free in the next 15 to 20 minutes or so to send us your stock symbol, your cost per share, and of course the number of shares. Don't need to know the date that you got into the position. But just if you want to, and you want to look at possible repair, once we show the example, send us the stock symbol, the cost per share, and the number of shares as well. Let us navigate now over to Power Options. And I'm just going to jump right into the portfolio tool with these example positions that I put in for today's presentation. The first one we see here is one long stock, and we're going to use that example, purchasing 100 shares of Kroger 21 days ago on December 30th for $42.31. As we can see today, another down day. The stock is currently trading at $36.93. That's right around $37 per share. Now, as you're tracking positions in the Power Options portfolio, whether they're covered calls, whether they're credit spreads, I have to change this. It says a bear put debit spread. I entered that wrong. I apologize. We'll fix that before we get into our spread examples. But as you're tracking, any position in the Power Options portfolio, you can use our Edit More Information button to link to the position actions and then the position analysis view. The position analysis simply gives you a breakdown of your current position. All right, we know that we have a 12.6% loss on Kroger, currently trading at $36.98. We're probably going to use the example at around $37 per share today. So after 21 days, we're down $533 of our investment, or 12.6%. Now, some basic rollout opportunities that are shown for our current position, it does show us an example of simply selling a nearer term call against our stock to generate income and maybe help lower some of the loss. So for example here, let me just get the highlighter. Nah, I don't want to use a highlighter, I'm sorry. Let me get the, change my settings here real quick, folks. I apologize. I want to just get a different color. I don't want to do hot pink here today. All right, so one of the ones, the near term call, with the stock at $36.98 right now, close to 37, we could sell the February 37.5 call, which would generate 85 cents against our current loss of $5.33. This is a type of repair. Just generate some premium against it, help hedge our loss. The problem with using the covered call alone and this strategy as a repair is that my cost basis is still $42.31. Okay, we take in 85 cents against it. I am going to lower my cost basis down to about $41.70 or so. But I entered into a contract to deliver my shares of stock at $37.50. So if the stock recovers in February, 30 days away, if it moves back up to 40, I'm either going to have to spend more money to adjust this covered call so I don't get assigned at the lower price, or I'm going to get assigned and lock in a 9.6% loss. Is that better than taking the 12.6% loss and liquidating right now? Of course. But at the same time, it might not be what I want to look for, and there might be a better way to go. All right. And of course, as you're looking at these rollout opportunities, it's great to see things numerically, but anytime you see a rollout opportunity, you can link the more information button next to the rollout opportunity, go to simulate trade, and this will just give you a side-by-side comparison. So in the blue here is our new position if we sold our call against it. And you see here, of course, this is not the kind of risk-reward profile we might want for our position as a potential repair. Okay, but one of the other tools that we wanted to talk about today and what we really wanted to show is a potentially better way to repair the position is to use what's called the stock repair tool. Now we can access this from our signature tools or directly from entering the symbol into the field. So I'm just going to type in KR, and in the upper right here of the main page, this will show on the home page or any page you first log into, we're going to click on stock repair. And this tool just needs our basic information here. All I have to do is enter in, of course, our cost per share. We were at $42.31, and our number of shares, which was 100. Now let's go ahead and submit that and see if we can see any repairs. The tool went out and it looked to find combinations in February, March, and April for our ratio repair, but we see here that there's NA, meaning that no repair could be found right now with our cost basis at $42.31. Now Kroger's down 12.6% from our purchase price for this particular position. I do, however, see, it has those weird strikes, but that's okay. I do, however, see some repairs for January 2017 and January 2018. Now, when you see details listed, the first thing we'd want to do here is click on the repair details so we can walk through what this repair actually is. We know the tool attempted to build a repair for us using these strikes that are listed, and we can see we can generate $1.60 worth of net credit, and our new break even is now $38.48. But how does that work? Let's click on the repair details for this January 2017 repair. So right now, with our 100 shares of Kroger, we could buy one 2017 36.25 call for $4.40. At the same time, we could sell two Kroger 38.75 calls for January 2017 at a price of $3. So we're going to take in $600 for the two calls that we're selling, and we're going to pay out $4.40. So we still receive a net credit of $160. But if our cost basis was $42.31, this should only lower our break even down to $40.70. How does that work? Well, we see that the new break even is at $38.48, not too far away from where the stock is right now. But in addition to that, it's much lower than our original price. Well, here's what happens. If we enter into this repair at January 2017 expiration, if Kroger's trading at around $38.50, we're going to have a $3.83 loss on our stock from our purchase price of $42.31. But remember, we bought one 36.25 call and we sold two 38.75s. If the stock's at $38.48, those two short calls expire worthless. We have no obligation to deliver shares of stock, and our 36.25 call will be at a price of $2.23. And we keep the $1.60 net credit that was received in. So we'd essentially get $3.83 back, which negates the loss on our stock. We're now back to break even, with the stock technically only needing to go up about $1.40, $1.50 from where it is right now as opposed to having to go back the other $533 that were down on the position. So this is a repair that would work for us. We would not need the stock to move back as much as we would expect to need without doing a repair, or maybe selling short-term calls against it and only receiving 50 cents or 60 cents at a time. And I will talk about that because it's important as well. But does the repair satisfy your needs? It does satisfy our needs, and if this was my personal position in just a long stock, it would satisfy my needs of lowering the break-even pretty drastically. Okay, down from needing the stock to go back up to 42 to only needing it to go back to 38. Does solve that need. But what about my expectations going forward? What if I think the stock is going to recover and maybe has the chance to move back to $40 or $41 per share? Am I in a good position? Well, it's, again, great to see things numerically, but it's always better to see them graphically. Let's click on the Analyze Trade button now next to our potential repair. This will take us to the profit and loss chart. So now we see with our 100 shares of stock, 42.31, buying one Kroger January 36.25 call at $4.40 and selling our two January 38.75 calls at $3, we now enter into a repair. But one thing to note, and this is a question that came in, this is, can you do this type of repair in a restricted account? If you're allowed to do spreads in your IRA or retirement account, you can do this repair. Now, most of you know, of course, let me go ahead and take out the stock. If I do a simple ratio call spread that I buy one call and sell two against it, we'd have a ratio repair where if the stock collapses, we have a profit of $160. That's the net credit that we took in. However, there's something ugly to the upside. And the ugliness to the upside is the fact that if the stock continues to move up, we could have an infinite loss to the upside. Why? Because we sold two calls and bought one. Essentially, that creates a bull call debit spread between our 36.25 bought call and our 38.75 sold call with a naked call position. All right, so one of our short calls is a naked call. The other short call is combined with the bull call debit spread. However, as we all know, the naked call has infinite risk to the upside because we don't have anything protecting it. If you were in a restricted account, you couldn't do naked calls in your portfolio, and you attempted to put this in as a spread trade, or what do they call it, X spreads at Options Express, for example, it might not go through. However, if you do own already 100 shares of stock at a price of $42.31, you can simply enter this as a covered call and then enter the other two legs as a bull call debit spread. And so your broker would allow you to do that again if you're allowed to do spreads in your restricted portfolio. Okay, but this is a January spread position. Our curved red line is showing us the profit and loss at the halfway point on July 22nd, 2016. Doesn't look very promising. Even if the stock recovers to 38.75 at the halfway point, we still have a loss of $338. Not the full loss we'd take right now of $533, but we're still in a losing position. Doesn't start to get back up unless the two options get deeper in the money and start to get closer to intrinsic value and the time value decays out. The blue graph here shows us the profit and loss at the expiration date, January 2017. Remember, our short calls are at 38.75. So if the stock was trading at around $39 per share, or let's say up to $41.25 per share, what happens? Our accelerated growth here on the profit and loss chart is because of the bull call spread. We're getting the advantage of owning the 36.25 call and selling that 38.75, so we're getting $2.50 credit back in addition to having our stock move back up in price. But once we get above our short call strike prices, we'd close out the debit spread for the $2.50 back, but the other short call is obligating us to deliver shares of stock at that strike price. Even if the stock goes back up to $44, $45, or $47 per share, we only have a max return now of 1.3% all the way out to January 2017. Okay, so this is a good repair in the sense that it satisfies the needs that we have of lowering our break even on the position. But in most cases, when I use the stock repair to evaluate the ratio call repair, if the credit repairs aren't available until a time frame that's 6 to 8 months out in time, I may want to look at something else, because if I do think the stock's going to recover even a 2 or 3 month period, I might be able to get a better return in the shorter term. Maybe even using just covered calls against the position, or maybe even using just a ratio call repair in a different situation. What do I mean by that? Okay, let's take a look. January, 11 months out in time, a little bit more than 11 months out in time, the max return of 1.3%. That's probably not going to match any of our trading goals, but it is better than liquidating now and taking a 12% loss. However, we know that if the stock recovers without management, we're not going to make more than that 1.3%. Remember what we talked about earlier. Common way to repair a broken stock may be to simply average down. A lot of us don't like to put good money after bad, but in some cases, we might get a much better repair. Let's close out this window. Let's go back to Kroger here. Now, we know the stocks, we're just going to use a price of about $37 per share. Okay? So we know that if we're in a position right now where we had 100 shares of stock at $42.31, let's get this calculator out here, and we bought another 100 shares at $37, we'd average our cost basis for the position down to about $39.65 per share. Well, with the stock at 37, if we put in another 100 shares, and now we have a cost basis of $39.65, and of course we have 200 shares of stock now, so our repair would potentially be to sell 4 calls and buy 2. Can we get a better repair on this position? All right, so now we have April repairs. It didn't find any for us for February. It did find one for March, but it's actually a debit repair, and the debit repair down here is only an extra debit of 10 cents. Now, here's a debate. Is it better to use a debit repair or a credit repair in this situation? Well, it would have to depend on the break-even number and the time frame. In other words, our April credit repair using the 35 and the 37.5 strike only generates a credit of 10 cents, but it puts our break-even at 37.28 at April expiration. It's about 80 days away. There's a March repair that we could use. It's about 58 days out in time. It's a debit repair using the same strikes, but for March, the debit would only cost us 10 cents, and the repair is at 37.38. So we're only paying in 10 cents. We're only in a 58-day repair instead of about an 80-day repair. And the break-evens are very similar, just 10 cents off. Okay, how would a debit repair work? Let's take a look at our March repair details. It's the same exact setup. It just happens that in this case, we didn't get to generate a credit. So again, we could buy 2, because remember we have 200 shares. March 35 calls at $2.90. That would be a total investment of $5.80. And we could sell 4 March 37.50 calls at $1.40, which would cost, we would get back, $5.60. And of course, you might be able to finagle the bid-ask spreads a little bit to maybe get that close to a wash. Okay, so this is a negative credit, so we pay a debit of about $20 for 200 shares, or about 10 cents. And again, we saw our break-even was going to be around the price of $37.38. Okay, and the stock's already around $37 right now, but the same situation we talked about happens before. Our new cost basis of $39.65. March expiration, the stock's at $37.38. We do still have a loss of $2.27 from our new cost basis. And of course, if the stock's trading at $37.38, that 35 call that we bought would be worth now $2.38 minus the debit, so we'd be back to $2.28 or a profit of 1 cent. Now what happens again if the stock goes above 37.5 at March expiration or before March expiration, and we're forced to deliver our shares of stock? Is it a reasonable profit? Again, let's click on Analyze Trade from our repair. And as we see here, it's not really as great as we'd want. It's only a 0.6% return if the stock's trading above 37.50 at March expiration. And at the halfway point, February 19th, about a month away, we're still at a loss of 360. Okay? But in this situation, if the stock began to move back up as I wanted to, and let's say it moves back up to 37.60, 37.80, maybe even $38 per share. Well, in this case, I could manage it. I could buy to close 2 of the 37.50 calls, which would be linked to my stock, and I could just roll that up to maybe the March 40 calls to generate a new premium. I could treat that just as a covered call and let the remaining 2 long calls at the 35 strike and the 2 short calls at the 37.50 strike keep as the bull call debit spread. As long as they stay in the money, we get that 250 back. That accelerated growth here on our profit and loss chart as the stock moves back up, and we get the difference in strikes benefit from our bull call debit spread on the stock repair. Okay. Of course, what might that look like? Let's say that in the next 20 days or so, Kroger does move back up above 37.50. Let's say it's at $38 per share. We still have around 30 to 40 days to March expiration. So let's say what would happen if we bought to close 2 of our 37.50 calls, just standard covered call management. Just think of it that way. The 2 calls that you have sold against your stock, treated as a regular covered call. Let's say that we'd have to buy them back with 20 to 30 days left for a price of $1.70. All right, so let's go to March. It's 58 days away, say 10, 15 days from now, about 45 days out. We add this back in. We're going to buy 2 calls at $1.80. Okay, so we close 2 calls. What would that look like? Well, now we still have sort of a stock position with infinite upside growth. We have this increase because of the bull call debit spread and the gain in the stock. And as the stock, of course, continues to move up, we could have infinite profit. But let's say we took a chance here. We treated it as a covered call. The stock's at 38. So maybe now we go ahead and sell the 40 call at that time for maybe, let's call it 80 cents. So we sell 2 more calls at 80 cents. Simulate this very quickly. But now still we've got a 4.3% potential return. This is, of course, a simulation if the stock was maybe trading at around $38, $38.25 per share in the next week or so. But is the potential to march now at a 4.3% profit, still taking advantage of that bull call debit spread and the increase in the stock. Remember, we lowered our cost basis by averaging down. So getting assigned at 40, we'd have a profit from our new cost basis of $39.65 of 35 cents, plus the 80 cents we took in. The $2.50 we'd get back from our March 35, March 37.5 spread, and then, of course, take out the $1.80. So it's not a bad return, 4.3% for essentially a 2-month repair when we're down 12.6% right now. But in these situations, when we have stocks, and most of us might have that right now, where we've seen that 10% decline in price, 12%, as we saw Kroger's down about 12.5% from where it was on December 30th, averaging down first. And I'm not one to like to put good money after bad, but averaging down first might be a way to help you get a better repair based on your expectations going forward and what you're willing to risk into the position and what you have available in your portfolio that has to be taken into account as well. All right, so our second repair we talked about, the debit repair, was only 2 months out, a potential for a 0.6% gain by itself, but then averaging down the position, getting into that better repair there. I'm sorry, what was that, Max? That was the 0.6% return, wasn't it? With the 2 new 200 shares, yeah, it was 0.6% for 2 months after averaging down. We didn't see any repairs without averaging down. Versus our first repair, we had to go out to January, 11 months away, for that potential max of 1.3%. Did lower the break even more by going further out in time and getting that nice credit of $1.60. But if you expect the position to recover more quickly, and you're kind of not in the mood, for lack of a better term, to sit on Kroger for almost 11 months to try to get back to break even, putting more money in, averaging down, and looking at a different stock repaired closer in months might be better for you. Okay? All right. And of course, if you didn't like any of the repairs that were shown, you could consider, Tom just sent this in, you could consider just selling weekly calls month by month or monthly calls against the position. But again, remember, now that the stock's fallen, it's at $37 per share. Selling the $37.50 1 month out on Kroger might only get me 60 or 70 cents. And if the stock recovers and we do have earnings coming up and it suddenly gaps up in price, I may have to pay more to buy it back and add to the position. So again, it comes down to your expectations. We had talked about that a little while ago. Let's take a look at the covered call situation. On the same day, December 30th, when we opened shares at Kroger at $42.31, we could have also entered a covered call by selling the February $42.50 call at $110. Kroger doesn't offer weeklies, so many of you might have used a 2-week out series on something such as Starbucks, Facebook, Amazon, whatever stock you're trading. But at the same time, I didn't choose the January series here because we just passed January expiration, so we wanted to use the February. Now again, as I'm tracking a position in the power options portfolio, I can link to that position actions menu and go to position analysis, and it'll show me potential rollout opportunities. Here we have a little bit less of a loss on our Kroger position. After 21 days, we're only down 10.9% because of the hedge of the call premium we generated. We, of course, could buy the call back now for 10 cents, essentially making 90% of what we expected to make on the call premium. The future expiration value just says if the stock's trading at the same price it is right now, what is my expected return? Well, it'd be 10.7%, a loss of 10.7%. That 0.2% just represents the last 10 cents of time value remaining on the position. Now again, as we saw before with our long stock, we see some potential rollout opportunities. We could buy to close our $42.50 call now and sell to open one of these new calls. But as we saw before, it does generate premium, $2.80 for the March 35 call, maybe a little bit too deep in the money, because if we're thinking the stock's going to recover, this might lock us into a loss of 9%. Slightly out of the money, March 37.5 call takes in half the premium, $1.40, but because of the higher strike, we could almost cut our loss in half down to just a percent if assigned on March of -6%. Of course, we could lower that by going to April, and we could say, that the April 40 call looks like the best bet because it has the lowest negative percent if assigned. Well, that, of course, is based on the stock being above $40 per share and recover. And we've already seen we could find 2 repairs on our stock position that could help us get back to break even at a much better price and have a profit, even if the stock's at around $38 or $37 or so, as opposed to needing the stock to go to 40 to still have a 1.4% loss for April. So for those of you doing covered calls and think, okay, well, I'm just going to roll down and out, I'm going to buy back my 42.5 and roll down in price, we've already kind of shown how the stock repair would perform better in those scenarios if you think the stock's going to even recover slightly, just back to $37.50, $38 per share. Now again, we can use this just as we saw before. And what I wanted to do real quick here, remember our cost basis was $42.31, and we had sold the February 42.5 call for $110. If we bought it back today at 10 cents, we'd keep the dollar premium, so our cost basis would be $41.31. Let's see a repair. Is that potential that we could get a better repair on Kroger with our cost basis for the covered call? Potentially. Let's see. So it would be $41.31 after we buy to close the call. We still have 100 shares. Without averaging down, do we get better repairs? We do, but again, as we saw before, we're still set out to January to find a decent credit or a debit repair in this scenario. Break even is a little bit better. The same strikes we were looking at before, we can get a little bit better net credit. Here's the same net credit we saw, the $1.60, but our break even is lowered because we lowered our cost basis down to that $41.31. Well, let me pull out the calculator again, and of course, would we be better off if we average down? Of course we would. So we'll take the $41.31 plus $37 per share. So our new cost basis would be $39.15 now that we've averaged down, 50 cents less, of course. So let's try that, $39.15, and we'd have 200 shares of Kroger at our new cost basis. Now let's see what we've got. We've got April credit repairs as we saw before, but hey, now we have a February debit repair using the 35, 37.5. It's a high debit of 85 cents, but our new break even is $37.50, just 50 cents off of where the stock is now. So rather than rolling down the covered call and potentially still locking yourself into a loss by going out to March, as we saw with the rollout opportunities, even April, we can get back to break even at $37.50 with a February series. Once we counter in what we've lowered our cost basis from the short call, by the way, this is the same thing you would do, put in your cost basis if you had a naked put that was assigned to you. Let's take a look at the analyzed trade for this February debit repair. Okay, so it's not as great as I had hoped, but again, it's a break even if the stock's at $37.50, no profit if it jumps above it, where, okay, we can argue that with the rolling the covered call to the April 40, if the stock gapped up above 40, we'd be at a loss of 1.4. Here, we'd still be at a break even, but remember, just as we saw in that last example, I would now treat half of my short calls, this February 37.5s, as a covered call, and if the stock did move back up to $37.50, I may look to buy these calls. I'd probably let it go 38, maybe $38.50, and then allow the buy 2 of these calls back, and then maybe sell 2 of the 40 calls, and we'd be at a higher profit, just as we saw before with going from that 0.6% gain, rolling half the calls up to the 40, turning it into a 4% gain. All right, real quick, Ray sent us in an example he wants us to look at. 100 shares of KO at 44.23. No problem. Let's take a look at our stock repair for you, Ray. See what we've got available. Okay. Okay. Oh, and you're short the August 44 call at 107. Okay, now it's at 95. See, that's the trick. Doing the repair on top of an existing covered call might not be the best opportunity, but you do have some gain in that call. So let's take a look at the first example. I'm sorry, let's go back to the stock repair for Ray. We're going to look at KO. He sold, let me jot this down right over the side here, he sold an August 44 call at 107. He can now buy it back for 95 cents or so, so that's putting us at a small gain of only 12 cents. All right, your original cost basis for KO, Ray, was 44.23. All right, so that would lower your cost basis down to 44.11 if you bought to close the August call right now. So let's plug that in. I'm sorry, yeah, 100 shares. Nope. K0 won't work, folks. KO will. Let's try that again. Fantastic. All right. So there are August repairs that are available. There are February debit repairs if you bought to close your call now, Ray, and analyze the position. 40.5 to 43, 40.5 to 43. These are using the weeklies, I'm assuming. That's why we're seeing so many Februaries. A March repair. Dollar debit, though, but 42.56. Nice low break even. 42.75. All right. Let's take a look at the March debit repair. Okay, now, true, the August credit repair is better. Break even is at 41.81, but that's so far out in time, we would have to be sitting on the position for another 6.5 months before we might realize the advantage of it. So let's keep it shorter term. A 42.56 break even is about 50 cents higher. I'm sorry, 75 cents higher. Let's look at the repair details. All right, so you could buy a March 40 call at 186, sell 2 March 43 calls at 43 cents. So you'd pay $1 debit for the debit repair rate right now in this position. But again, if the stock's at 42.56, March expiration about 58 days away, you'd have $1.55 loss on your stock from the 44.11 cost basis, but your 40 call would be worth $2.56. So the extra $1 there counters the debit we paid in. You'd be back to break even at 42.56. And of course, as we saw before, we could go ahead and analyze the trade. Does it result in a reasonable profit? Yeah. If the stock goes back up to 43, or 42.56, excuse me, Ray, you might have a profit of 2% as opposed to, I'm sorry, the stock at 40.82. You got a little bit close to about a 10% loss in this position, around a 9 or 10% loss. Okay. Now, why do I have to buy to close the short call first? Okay. The reason why is that if I left the short call that we had open, that August, I'm sorry, it was a 44 call. Let me add that back in. Now it's an 88 to 97, so if you took the midpoint there, you could get a much better price, maybe 92 cents, 93 cents or so. Well, that's all right. Let's go ahead and sell your call back in, your August at 107. Well, remember now with this repair, you now have 3 short calls, and you've got the 1 long call. And the reason why I'm always hesitant to do this, I don't like to see infinite risk to the upside on a position, especially as we enter into earnings season. So you could lower your cost basis slightly by buying to close the call now. You didn't get a lot of premium off of it. Now, let me just take a look here. Let's go back to this real quick. In this scenario, if the stock goes back up to $42, $43 per share, your break even is $42.56. Okay, so let's just use that. But if it goes above 43, you have a max profit of 2% on your Coke position, on the KO position. 42.56 is our break even. Now, let's go back to your current position. Okay, and we've got stock at 44.23, and we had sold the August 44 call for 107. All right, so naturally we submit that. We know the covered call scenario. Got a risk of about a max profit, of 1.9%. Stock moves up. Could we just roll down now? Well, let's take a look. We know before we saw the buyback price from August. We could buy back the 44 call. I'm going to put it at 93 cents, closer to the midpoint. Okay. So let's buy to close that. We know what's going to happen. We're going to have a cost basis now of 44.09. We just have a long stock position. But what if we sold the August 42.50 now? Does this put us in a better position? Oh, we'll use the 42. $1.60 to $1.69. Let's be nice to ourselves and call it $1.65. All right, so now we see the problem with just rolling down the covered call. Okay, rolling down the covered call in this scenario, we do generate a credit of 75 cents. We've lowered the payout by $2, so now you're at a potential loss of 1%, where our repair could put us in a position to make 2% at the closer in expiration. Okay, so the repair would solve more of our needs with the stock going up to 42.56. Here, if the stock goes up to 42.56, we're still at a loss. We've got to pay to close our 42 call in order to roll the position. So that's why I think that repair that we saw after buying to close the call that you have, lowering your cost basis to 44.09, and then, I'm sorry, our repair was the March 43. Okay, so let's put that in. We're going to buy a March 40 at 186 and sell 2 of the 43, but let's use midpoint here. Let's call it 182. And we're going to sell 2 43 calls here, 45 cents. Remember, this is still the debit. Okay, this is still the debit repair in this case. But remember, now using midpoints, we can get to a gain of 2.2% in March if the stock's at 43 and the break even is an even 42.50. By rolling down your call, if the stock was at 42.50 for August, you'd still be at a loss of 2%. And so that's the advantage of the repair at using that debit spread as opposed to the common thought of just rolling down the call and rolling down the call. Remember, those who are doing covered calls, you always lose more on the stock than you gain by rolling down the call. Okay, it's just the nature of it. So depending on your outlook going forward, the repair might work better. And of course, I apologize, folks. Of course, the one thing that we look at in this position is we haven't addressed the downside. So if the stock continues to fall, just like most of the bullish repairs for any strategy, most of the repairs for a long stock, a covered call, a naked put, bull put credit spread, bull call debit spread, or calendar spread, they're based on having the stock move back up in price. But we wanted to show today the advantages of the ratio repair over the standard thoughts of just averaging down and waiting or just rolling the covered call as well. Okay. Now I'm going to go back to the portfolio and make a change real quick. And we're going to talk about a couple of other things here as well. I did this position wrong. I need to edit the position. So here we go. Edit the position. All right. All right, so we need to change this to the February 35 put at 15 cents. I need to change this to the 40 put. I entered a debit spread instead of a credit spread that we meant to use, and this was at 0.85 cents as well. All right, so I'm going to toggle back over very quickly. Give us a view. Oh, sorry, there we go. Okay, so when we talk about bullish spread positions, I know many of you might be in the situation whether you're using weekly, whether you're using standard expirations. The bull put credit spread, when we sell an at or slightly out of the money put and buy a lower strike put, well, in this kind of market, we're in the same situation. The stock has maybe dropped below our initial sold put strike price. We may be obligated, or forced to buy shares of stock. And if it's dropped below both puts that we entered in the spread, we're looking at the maximum loss, even though we're not at expiration or pretty close to it. A bull call debit, parity trade, same setup, but we used calls and we're in a debit to enter the position, but now the stock may have fallen below our short call as well. And those of you who may be doing calendar spreads where you bought a far out in time call option and sold a near-term call against it, well, you might be close to the maximum, your short call that you sold, as we saw with that $1.10 call on Kroger. We might be able to buy it back for 10 cents, but that long call that we bought, even if it was deeper in the money, the 37.5 or the 40, is now looking at a large leverage loss on the position. Okay, so for those of you who are unfamiliar with the bull put credit spread, sorry folks, let me just do this very quickly. I'm just going to show a quick graph. This would have been the bull put credit spread we would have opened at Kroger on the same date of December 30th. Okay, so on December 30th, I may have sold a February 40 put. Remember, the stock was at 42.31. We may have sold a February 40 put, generated 85 cents, and we could have bought the February 35 put for 15 cents. Now, I have a 5-point difference in strike prices, but we generate the $7. This is 10 contracts, so it would have been $700, or 70 cents if we just did one contract, against the risk of 5 points. So we would have a $4.30 risk to make 70 cents, which gives us a 16.3% potential profit. If Kroger stays above both strike prices, we'd want, in that scenario, both puts would expire worthless. We'd keep the net credit. We'd have to put up the $4,300 to make $700. But we look at this, and what is this? Well, this is a 6-point whatever, but a 6-to-1 risk-reward ratio. We run the risk of losing $4,300 if the stock drops below 35 in order to try to make 700. Nature of a credit spread having a relatively high probability, which this did at the time. But market conditions sort of took care of that and threw it out the window. So this is your profit and loss chart of a bull put credit spread. I did sell a put here, so my obligation is I may end up buying shares of stock at the $40 strike price if the stock is trading below it. But I also bought a 35 put at a lower price. That generated the credit for us. And this obligates me to force someone to buy shares of stock for me at 35. So again, if it fell below at expiration and I did nothing, we'd run the risk of losing the 5 points between the position, but we keep the 70 cents. We'd have a loss of $4,300 or $4.30 per position. Okay? All right, so where do we stand now? Well, we stand in hot water. The stock is at 36.79. Our 40 put right now is going to have a high buyback cost, okay? And we can see it in the portfolio here. Our short put has gained in price to $3.60, and our long put, the 35, which is still out of the money, has only moved up to 60 cents. So we're looking at a loss of $3 or $3,000, not the full 4,300, 3,000 if we liquidated this position. Now, what are some of the ways that we might look to manage a bullish spread, whether it's the bull put credit spread we just looked at, or a bull call debit, which is a parity trade, but we paid the debit in instead of receiving a credit up front? Well, we could liquidate and take the loss. No one wants to do that, but if I maybe can close it out now, if I don't think the stock's going to recover on the position, close out the bull put credit spread now. we'd only take a $3,000 loss, as we saw, instead of the $4,300 max loss if we leave it to expiration and the stock continues to fall. One of the most popular ones is liquidate the spread now. So we'd realize that $3 loss on the Kroger position, and we try to make it back by maybe doing another bull put. Okay, well, the stock's at 37, so I might sell a March or an April 35 put and buy the 30. But remember, that $3 loss we were talking about, that $3,000 loss, factors in the original credit we took. That's already in there. So would I likely get a $3 credit on my 10 contracts by selling a March 35 or even an April and buying the 30? I highly doubt it. Okay, so rolling the spread down, a common way to adjust a bull put credit spread in that position, may or may not work well. Another idea for managing a bull put doesn't work on the bull call this way, but on a bull put, as the stock started to fall to 40, the put that I sold, I may have looked to buy to close the short put. That would realize a loss on the position, but leave the long put open. If my sentiment has changed and I think the stock's going to continue to fall, buying to close the short and leaving the long open will leave me in a long put position. But now I have to take into account that we originally received a credit, remember, of 70 cents on the position. We're going to buy it back for about $3, so we'd have a loss on the position. Well, that's already factored in. We have a loss of $3,000 or $3 per contract. So with being long the 35 call, I have to factor in my cost basis is $3, so my break even is now $32 per share. I needed to drop another 5 points by the February expiration. Okay. Another common way to adjust it is add the opposite spread. I have a bull put credit spread right now. I may try to trade a bear call credit spread, generate 50 or 60 cents of credit, so now I have an iron condor position. But I have the word minor in here. Why is that? Because sure, the stock could recover by February expiration. Remember my 40 call here, I'm sorry, my 40 put here, and I'd probably right now use the 45 call potentially, or maybe the 42.50, it'd be the 42.50. But I'm probably only going to generate 20, 30, or 50 cents for that new bear call. So if the stock recovers, I could enhance it, but if it's still in this area, I only hedged that by 50 cents. I didn't really repair it, okay? One of the more common ways that I think to adjust these positions, look, I entered a bull put credit spread on Kroger. I was wrong on the Kroger, but I was wrong on the entire market. The entire market went bearish on me when I was in bullish positions. So instead of liquidating and roll the spread to lower strikes, which have the problem of continuing to move down against me, and then I'd have a loss on my new bull put and then manage that and then have a loss on the next bull put, maybe I close the spread and do the opposite. I now enter a bear call to try to help me repair this $3 realized loss per contract I'd have on the initial bull put. Okay, and then another way to adjust it is what we call the pendulum adjustment, which essentially allows us to turn our bullish spread into a bearish spread, but without closing the position, both legs of the bull put, and then opening a bear call. We can change the bull put to a bear put debit by just moving one option. Okay, so those are some of the ideas for a vertical spread position. We're not going to have time to go into that today because it's already 12:58. I'm going to talk about a pendulum adjustment on the Kroger bull put real quick. We have a couple other questions that came in that I want to address, all right? And then I'll show you where you can see some further examples of what I just talked about with the management techniques of a vertical spread. So let's take a look at our bull put credit spread again. We know that's going to cost us about $3.60 to buy to close our short put. And we talked about maybe if our sentiment has changed, now the stock's below $40 at about $37 per share. If my sentiment's changed and by February expiration, I think the stock is going to remain below $40, I'd want to put myself in a position that reflects that. Here's 40. I want the profit to be on the downside where I think the stock's going to be, not to the bullish side. Okay? And we could just liquidate this and open a bear call, but is there a way to repair it just by adjusting what we currently have? Absolutely. The pendulum adjustment, in order to turn a bull call or a bull put credit spread into a bearish spread, where we want the profit and loss to look something like this, potentially, what we can do is just swing our long option to the next strike. I'm going to sell to close the 35 put, and then buy to open an in-the-money 45 and see if that puts me into a profitable bear put position. We call that the pendulum adjustment. I'm just going to swing the long to one side. So let's simulate that. Would that work for this Kroger bull put credit spread? We already have the 35 and 40 put added. I'm going to click the 35 again, and let me erase the drawings there so it's a little bit more clear. And instead of closing both legs, we're just going to close the one. I'm going to sell to close the 35 put, and we're going to put it at 60 cents. The natural bid doesn't look like we get 62.5. Now, I'm going to spend a lot of money here. There's a wide bid-ask spread. We're between 6.90 to 9.10, so we're looking at a difference of $2.40. So midpoint would be 120 up. So let's call that 7.90. It's going to be expensive. So we only got 50 cents against it. This repair is not going to work, by the way. I can already tell. We're going to get 60 cents back. We took 70 in already, so that's $1.30. We're going to have to pay 7.90 in, so this puts us down at 6.60. What I need to have happen is the difference between the initial net credit that we received the net credit plus the sell to close of our open position minus the buy cost for the new option has to be less than this new difference in strike prices. We're going to keep it at 5 points. Okay, that's the only way that works. Here we can see that our total debit is going to be 660 now, but we have a 5-point spread on the position. All right, so let's go ahead and add it in, see what it would look like with our midpoint of 790, ladies and gentlemen. All right, submit that. All right, well, we did convert the bullish position to a bearish position. We took our bull put credit spread, used the pendulum adjustment to make it a bear put debit, but we're still locking into a loss. We're not in the profit zone. But if it stays below 40, we'd only have a loss of $1,600, which is better than the $3,000 loss we have right now if we liquidate the position, better than the potential $4,300 loss if the stock continued to fall and was below 35 at expiration. I'm not saying that this is a great repair and this is something that I would do, putting myself into a repair where I'm guaranteed that the best I can do is only lose $1,600, but it does beat the alternatives that we're in right now. Okay, so we didn't have a lot of time to talk about our credit and debit spreads today, but as we showed earlier, the link that I sent everyone, poweropt.com/webinars.asp. If you go there and you go to option strategies, there are full presentations on managing your long options positions. If you have long calls that are under you, you can see some repair ideas here. Managing your spread positions. We go through full examples of those 6 or 7 ways we just outlined for managing the spread positions. And of course, if you're just doing bull put spreads, there's a full presentation here just on bull put spreads, not looking at the other 3 vertical spread positions. Okay. Real quick question that came in. Bill asked, does a pendulum only work or work best when the stock is between the 2 sides of the spread? Bill, that has been my experience. When I don't want to say I created this pendulum adjustment. I know people have used it, but I didn't see a lot of people doing webinars on it 5 or 6 years ago when I started using it in my personal account. I thought it was better to just, and a lot of people were talking about smaller accounts and even using weeklies. The commissions really take an effect to it. Well, if my repair is to liquidate 2 legs of a spread and then open 2 more legs to do the opposite, why not just create an opposite position by rolling 1 leg, okay, and keeping better commissions? But you're absolutely right. I found it works best when the stock is between both strike prices. That's usually when the repair works best. When can you use to see if it works? I'd say the pendulum adjustment can work if the stock is right around your short option strike price, Bill. It doesn't have to be between the 2, but in most cases, I think it's better, of course, when the stock drops and is between the 2 strike prices in the case of the bull put we were just describing, only because I want to get some good value out of that long call. Okay, if that makes sense. You know, I want to see that position. I'm sorry, completely rephrase that, Bill. I want to see some advantage in the long put. Remember, we just looked at our portfolio. When we opened this position, Bill, the stock was at 42.31. Now it's at 36.75, 36.79. Okay, we've seen a drastic gain in that short put. I really don't want to mess with that if I don't have to. I don't want to pay that money to buy it back. But now, even with the stock closer to the 35 put, this is only worth 60 cents, right? If I did it when the stock was at 40, it might have only cost me $1.50, $1.75 to buy to close the 40 put, but that 35 put would probably only have been worth 20 cents or 30 cents. Haven't gotten a lot of gain out of it yet. So in this case, it's better to wait for them to go between. I also like to show that pendulum adjustment because a lot of us miss that opportunity. In that spread webinar I just showed that you guys can access and link to at any time, managing your bull put spreads or managing your vertical spreads, we do show examples of the other adjustments. But that's based on our rules for rolling a spread position. And we talk about that in that other presentation. If the stock's within 1 or 1.5% of the short put strike price, if you use delta as a point to enter your position, or maybe probability, you might use a change in probability or delta as a trigger to adjust your bull put spread before the short put goes in the money. But we're not always that lucky. A lot of times it goes between, and the repairs that we would use if the stock reached that short put strike price in normal conditions, if it did hit our trigger, well, we miss that. And the normal repairs that we would use don't work as well once it's between the strike prices. But that pendulum adjustment is the one that does seem to work best when it's between the strike prices. Unfortunately, for our example today, the Kroger one didn't pan out, but you'll see examples in that other webinar of ones that do. All right, Ed has been patient. He asked a question a little while ago. January 12th, bought Apple at $99.96 and bought a July 2016, excuse me, I'm assuming this is a married put that Ed entered, a radioactive trade. He bought a July, but I don't see the strike there, and no calls sold yet. 125, okay. Are there repairs? Well, you could probably use, depending on your outlook, Ed, if you consult the blueprint, you're going to want to take a look at income method number 9. Okay, that's one of the things you could do with Apple. Too many A's. All right, so 100 shares. Let's just, I'll go to 12. 0, and you said 99.96. And I bought a July 125 at 26.63. Okay, so we had this. Okay, 1. All right. All right, so same as we did before, we've got the married put here. It's down about $6, but hey, look at this. If I enter the prices right, you've got about a 1-to-1 gain on the position, so you're not losing much at all. You're only losing 20 or 30 cents. Apple's at $94, okay? So if you're expecting it to come back up, it might be best to wait on it. One thing I always check in these situations before I adjust a married put, even though it's down, I want to go to the research tool, the stock repair tool. I'm sorry, stock detail page, and I've got earnings coming up on 126, about a week away. I can't give any trading advice to you, Ed. I may be tempted to leave this position as is going into earnings. If the stock falls, you've still got protection in place. If the stock moves back up, you might see some opportunities to generate income. The reason why I say that, let's go to position actions and position analysis. All right. So your max risk is very small. It's only 1.3% on your married put position. Right now you have a liquidation loss of 0.2% or $25. I'm not sweating this position too much. You see some rollout opportunities for income method number 9. Now, why would I want to use this by rolling down or closer in? You increase your maximum risk slightly on some of these adjustments, but now that you have a lower strike price, you might have better opportunity to do other adjustments following the rules in the blueprint. Okay, that income method number 5 we showed, the ratio call spread, when I'm in a radioactive trade, that's referred to as income method number 5. That might be able to be done, Ed, as a repair as well for your radioactive trade. Maybe not the best solution. Kurt might point you to income method number 11 in this type of scenario. But anytime we're analyzing any repair on a position or an adjustment, whether it's a covered call that's moved against us, a long stock position, a position we have great protection in this married put. I love this 1.3% risk for this married put. It's a little bit deep in the money for the put now with the stock at 94, but there's opportunities to adjust that would in this case increase your risk. There's combinations that you could use where you could still have a maximum profit or a potential gain on the position using shorter term calls, combination of 9 and 1, but your maximum risk does go up higher. Okay, so you'd have to analyze those. But if you're using power options, you can take a look at some of those rollout opportunities and adjustments. If I'm, again, I can't give any trading advice, but anytime before I do an adjustment, before I evaluate a repair, I consider what's coming up. And we are entering into earnings season. With your earnings only about 7 to 8 days away, I'm sorry, about 6 days away, actually, 6 or 7 days away. My apologies there, Ed. And you're only at a loss right now of 0.2%, and you've only got a max loss of 1.3%, you might just want to wait the 6 days, see what happens after earnings, and then let's reevaluate that position going forward, because if the stock does have a gap, let's say it goes back to 105 or 110 maybe, you might see some other opportunities that we're not even considering right now with the stock down in price. If you expect the stock to fall further, there might be some opportunities you can do to take advantage of the downside as well, such as income method number 12, or combination, of 6 and 12 as well. That's one of the things that you might want to consider also. All right. Okay, well, if anyone has any last-minute questions, I encourage you to send them in, questions, comments, or things of that nature. One thing I wanted to address, does the stock repair work for options plays? That ratio call spread work for options plays? You have to be very careful. Could I have used the ratio call spread to repair the bull put credit spread? Not really. Remember, the advantage of doing the ratio call repair is that I already own stock. So when I sell twice as many calls as I buy, it creates a covered call with a bull call debit spread. If I have a bull put and try to apply the ratio call spread, I now have a bull put that if the stock recovers, I can make a profit. Oh, I'm sorry, folks. I have a bull put that if the stock recovers, yay, my bull put goes back to profit. But my ratio call spread, I sold 2 calls and bought 1. The bull put does not cover the obligation of that second short call, so now I have infinite risk to the upside on the strategy I'm attempting to use to repair it. And that's just a mess. Okay, that doesn't get me anywhere well at all. Okay, so for spreads, it adds complexity, and then it probably puts you in a worse situation if the stock does move back up as you expected. Now, for long calls, it might work, but you've essentially created 2 spreads. All right, so if I had a 40 call or a 42 call on Kroger and my stock fell to 36, if I did a ratio repair of the 37.50 and the 40, bought 1 and sold 2, and now I have that other call at 42, I now have a bull call debit spread and a bear call credit spread. I've created an iron condor, or you might create a broken wing butterfly. Is that a repair? Well, yeah, if the stock moves back up, it could repair it, but remember, you don't own the stock as well, okay? So that kind of changes the complexity of using it against the positions. Now, when I'm evaluating a stock repair for a stock that's fallen in price or a covered call, if we have a small loss on the long stock, the covered call or naked put position, let's say it's a 3 to 7% loss, we'll use the portfolio, the position analysis to evaluate rolls. I'll reevaluate the sentiment on the stock. If I think it's going to continue down, maybe I'm just going to get out of it and look for a different position. And then I'll compare simple roll adjustments to the stock repair if it's a smaller loss. But if we do have a loss that's around that 8 to 10 to 12% range, rolling is not going to put us in the best situation. We saw 2 examples of those, just rolling down your covered call or selling a lower strike call against it. Evaluating the stock repair for a quicker repair on the position is probably a better idea, and you can then combine management. You might consider averaging down. I know we don't always like to throw good money after bad. We could average down, then evaluate the stock repair, and that might put us in a better position. But before you make any adjustments, you always want to make sure to reevaluate your stock sentiment. Okay? Jim brought up a point here, and it goes to the same thing as rolling down a covered call that we compared earlier. So let me go ahead and just navigate back very quickly, see if I have these windows open. Jim mentioned instead of average down, you could sell an OTM put. Well, yeah. Okay, I understand what you're saying there, but that has the same risk reward as rolling down the covered call if you're already in it or selling the lower strike call. Jim, you're right. If I sell that out of the money put, now that this stock has fallen, I could sell the 35 put on Kroger for February or for March, and if the stock falls, I could get back in at that lower price. But that doesn't give me the advantage of averaging down now to get the lower cost basis and finding a better repair. The repair would not give us the same risk-reward profile if I had long stock, a short put, and then did the ratio call spread. Because remember, if you own stock and you sell a put at that time, depending on which brokerage account you're in, the long stock doesn't cover the obligation of the short put. I still have $4,231 invested in my 100 shares of stock, and if I sold the 35 put, I'd have to put up another $3,500 right now to cover that obligation. So I'd have $7,700 on hold in my account right now, which is almost the same as averaging down and then being able to do the repair if I think the stock's going to move back up. But you bring up a very strong point, Jim. And that point is, when we were looking at the Kroger stock earlier and we looked at the repair, let me just go back to the, is it still there? Let's just do KR again very quickly, put us back in that position for the stock repair with the 100 shares at 42.31. All right, we had our January repair. All right, so adjust this now. Let's go to Analyze Trade. Is this the one I want? Yeah, the 36.30.38. Let's go into that field. And now let's sell a close-in February 35 put. All right, 55.60 cents. We knew where our gain was before. Yeah, let's do that. Okay, so now I have $7,500 on holding the account. The $4,000 already invested plus the $35 I need to cover the position. I generated another 55 cents in addition to that great credit we received for the January repair. But now at short-term expiration, even if the stock goes back up to 48.80, I'm still at a loss of $41, okay, because of the cost basis and the extra potential premium, right? Because it's basing it now on March, not at January. And I could try to sell month by month. But let's say when I do the repair, Jim, just I was talking about on that last slide, always reevaluate your stock sentiment before doing a repair or any adjustment. Why is that important? Because if I think the stock's going to continue to be bearish, I am going to do something else. I might add a put at this time or two puts to take advantage of the downside or just get out of the stock position altogether. If my sentiment is that in the next 30 to 40 days, I think the stock might move back up to 38 or 37.50 or $38 per share, in this scenario, we're still at a loss of $399 using that original repair with only our 100 shares and hoping to get back in the stock at 35, which is almost counterintuitive, isn't it? And what I mean by that is if I sold this out of the money 35 put, and I'm saying, okay, well, I'm going to average down to get the stock put to me. I'm going to hedge this a little by 55 cents. Well, I'm still going to be losing another $2 on the 100 shares I own. I'd be down $7.50 on my initial 100 shares, and yeah, I get to average down at 35. All right, so with that calculation there, my apologies, folks. If we take into account 100 shares at 42.31 minus the 55 premium, plus $35 if we get put these new shares of stock at February expiration, our new cost basis would be $38.38. So then 30 days from now, with the stock at 35 and our cost basis at $38.38, a loss of $3.38, we could then evaluate a new repair. But again, remember what happened. If I averaged down right now, without waiting for the other 30 days, generating 50 cents against it, if we average down right now and put our cost basis at $39.65 for 100 shares, we saw that by March, we could have a repair if the stock's at 37.43, instead of the stock being at 35 and us having a cost basis of 38.38. And right now, remember, if that happened, Jim, the stock's below 35, my new average down cost basis of 38.38, we have a loss of 338 on the stock, and then we'd look for a repair. Very true. I understand. And that's a good point. That could work. However, if I average down now and the stock's at 37, I'm only at a loss of 265. In order for this scenario to work, I'd have to get put the shares of stock at 35, which means I'd already have a larger loss because the stock would be somewhere below 35, and I'd have a cost basis of 38.38, that includes the 55 cents for selling that out of the money 35 put. Okay, so it's a value of numbers at this point. What's better? Maybe averaging down and having a loss right now of only 265 and then seeing some repairs available for a shorter term time frame, or waiting another 30 days to see if we can get a lower cost basis of 38.38, but in order for that to happen, the stock has to continue to fall. And remember, if you're in a long stock and a short put position, a naked put position, you are into bullish strategies, but you're planning on the stock to drop to get a better advantage of it. That's very strange. It's not strange, but it is kind of strange, isn't it? You're in a naked put, which is a bullish position, and you're in a long stock, which is a very bullish position, but you're actually hoping the stock's going to drop another $2 to make your position better. Ooh, it's kind of a strange thought, isn't it? But in that case, that's what it would be doing. So work the numbers. There may be scenarios, Jim, where that might work out for you, but right now you could take better advantage, I think, by putting more money in, almost near the same amount of money you'd put to cover the cash secured basis of your naked put position if you were obligated to buy shares of stock at that strike, but putting it in now into that position to average down and then finding a repair that might be only 40, 50, or 60 days away, as opposed to still hoping that in the next 30 days you can average down, but the stock's down 3 or 4 more points below where you thought it was going to be. Now, the hard one for losses, yeah, and you still keep the credit of 55 cents. I get it, Jim, and you're absolutely right. So if in February the stock's still at 37, and we now lowered our cost basis from 42.31 minus the 55 cents down to 41.85, I'd have to look at a repair for the stock at 41.85 if the stock's at 37. Why not do it today if I can get the cost basis down to 39.65 or a little bit lower, instead of having a cost basis of 41.75 just from the 55 cents we collected? Okay, that's kind of the numbers you want to look at. Now, for the big losses, something gapped against you. Some of us might experience this as we get into earnings. If you have an earnings surprise in your long stock, your covered call, I encourage you to turn your covered calls into collar spreads and add an out-of-the-money put potentially if you're going into earnings for extra protection, or maybe converting your long stock positions into a married put as well, because stop orders don't protect you against the sudden unexpected losses. It may be hard to repair without averaging down. You might have to do a ratio average down of 3 to 1 or 4 to 1. I really don't recommend doing that, of course, for the reasons we talked about. Throwing too much more good money after bad. It's really essential to reevaluate your stock sentiment when you're looking at a loss of that kind. No one wants to take a loss, but is it worth it to sit on the stock that's down 30% and try to manage it for as much as 12 to 24 months just to try to get back to break even? What do I mean by that? Let's say I bought a stock ahead of earnings. I put a stop order in, but there's an unexpected 35% downturn because of poor earnings or poor future looking. That 7 to 8% stop loss doesn't help me. It gets violated and I potentially get closed at the 35% loss. Let's say I had no stop loss in and it just suddenly drops down to 35% because of earnings. The average at the money covered call return right now across the market, it's been going up and down with the VIX, of course, but it's around 2.6, 2.7%. So with a 35% decline, if I just sell the at the money and I assume that I can get about 2.5%, we're still looking at about 14 to 15 months of premium to get back that 35%. Okay? That is a tough pill to swallow. That's the best case scenario. If you don't have a sentiment that the stock's going to recover and you just plan on selling at the money calls and it's going to stay at this new price level it's at, that's going to be a year and a half, a year and 4 months, a year and 2 months to get back to break even with a standard premium of just using a covered call to repair it. Okay? Can you avoid losses to begin with? Well, yeah, position sizing and trade management. If you're in a credit spread, make sure the contracts and the amount of money you're risking doesn't really represent more than 2 to 3% of your total portfolio value. And in reality, in my opinion, if the credit spreads, if you're doing credit spreads in your portfolio, you really shouldn't be doing that speculative kind of risk-reward ratio of a credit spread or a vertical spread with more than 15 to 20% of your allocated capital, because you can lose it all in an instant. Most people who have been doing bull put spreads since the beginning of January have seen loss after loss and been trying to manage it, and it's almost trying to catch a falling knife. Their losses that they have, they're lucky if they're going to be able to make them back over the course of the next year in some cases. Okay, develop a trading plan and stick to it. We all know it, but you always want to reinforce it. And then, of course, there's the difference of insuring a stock or insuring a portfolio. It is better, although more expensive, to insure stock directly. We have other webinars that you can view, plus on our blog. You go to powerup.com, you can click on the blog, but there's articles on using puts on indexes and ETFs to insure entire portfolio, or using call options on the VIX, the VXX, or counter market ETFs, and the pros and cons of each of those. Now, why is it better to insure stock directly if we have all these neat little things we can do to protect the portfolio? We ran an example a few months ago. A gentleman was in GE. A large portion of his portfolio was in GE, and he thought what he was going to do to protect his portfolio is he noticed that most of his stocks in his portfolio were S&P 500, covered calls, some naked puts, things of that nature. So he bought puts on SPX and SPY, really. He bought puts on SPY. Now, unfortunately, what happened to him, this is actually, I'm sorry, it wasn't near a few months ago. It was over the summer. But what happened is during the time frame leading up to that, GE was down 18, 17%. SPX, the Standard & Poor's 500, S&P 500, was up about 9%. It wasn't that high. It was 4%. That's what it was. It was 4%. So his puts all lost value. The largest portion of his portfolio declined in an extreme value, and the protection he purchased did not help him. Okay, so if you have that much of your portfolio allocated to one position, as expensive as it is, it's best to insure it directly, because the rest of the market might go counter to your position. You might end up losses. Also on the blog, there's a discussion on the barbell approach for investing, on setting up your portfolio to 70 to 75% into protected positions, and then still having fun, for lack of a better term, with 20, 25% in more speculative positions of buying calls, credit spreads, and so forth. And we talked about the stock or portfolio insurance, and of course, other ways to limit risk, radioactive trading techniques, which some of you asked about today, and of course other protective option strategies, standard collars, converting your covered call into a collar as you approach earnings, so you have a guaranteed maximum loss of only 4 or 5% instead of assumed insurance of a stop order at 7 or 8% as well. All right, now for those of you that came in that just got one of the free reminder emails that currently haven't started Power Options yet, you liked what you saw in the portfolio tool or the stock repair tool, if you haven't done so yet, go to powerup.com. You just need first name, last name, and email address. You can start your 14-day free trial. After that, 20-minute delayed service gives you access to our search capabilities, our analysis tools, and of course everything else. With 20-minute delayed quotes, is only $60 per month. And we also offer a real-time service, which is $100 a month. So every time you refresh the pages, you get the numbers and calculations at that very instant. And of course, on the top of the 20-minute delayed and the real-time service, for $40 more, you can add the historical services as well. All right, as I mentioned, I will post today's webinar. It will be available under that Option Strategies tab. It will replace the Manage Your Broken Stock webinar that was posted earlier. If you think of any questions, please feel free to send an email to me, just support@powerup.com. You can also call us during market hours at 302-992-7971. I am not going to be available for maybe the next 15 to 20 minutes or so, but you can call us later on in the afternoon. Of course, there's contact links at the bottom of every Power Options page as well. Well, ladies and gentlemen, I want to thank you again for joining me this afternoon. I hope you enjoyed today's presentation. I hope you got some useful information out of it. Harry says, wow, incredible analysis. Need to watch the recording to better grasp the concepts. I'll let everyone know via email when this webinar is recorded and available on the webinars page. So John, Jim, Ed, thank you for everyone for all of your questions. Thank you all for joining me this afternoon. Everyone have a great day. I hope we have a better trading week going forward. And remember, we'll be back again, another presentation Friday at 4:30 p.m. Eastern Time, our Power Options Open Forum Q&A session. You can register for that right on that webinars page or right at powerup.com. Take care, everyone. Good night. We'll see you soon.